In this video, I'm going over 6 top stocks for the month of June 2022. There are thousands of companies you can invest in, but for my research, these are the ones I think should be on your watch list. I encourage you to watch until the end to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow in the long term. Let's get started. So the first stock we are talking about is the Vanguard Value Index Fund, stock ticker VTV. This is an exchange traded fund that tracks the performance of the CRSP US Large Cap Value Index, which essentially measures the return of large cap value stocks. Given the performance of a lot of growth stocks recently, I thought it'd be really important to include this one in the list. So right now, one share of VTV is trading at $145.29 with a 52-week low of $133.51 and a 52-week high of $151.89. This fund has net assets of $145.28 billion, an average yield of 2.32%, and a really low expense ratio of just 0.04%, meaning you're basically not paying any fees. Here's VTV's price chart for the last year. You can see it's performed a lot better than the S&P 500, and it's pretty much just hovered between $135 and $150. In the last 5 years, you can see that it's grown exceptionally well, of course with that big dip at the beginning of the pandemic, but since then it has recovered really nicely. It's categorized as a large value fund, and if you take a look at these sector weightings, we can see that we're really heavy in financial services at almost 20%, consumer defensive at 11.94%, healthcare at 21.2%, and industrials at 12.06%. Technology is a much smaller part of this fund at just 8.36%. We have an average price to earnings ratio of 18.96, average price to book ratio of 2.7, and looking at the performance overview, we can see that we had a negative 2.28% year-to-date daily total return, a positive 5.04% one-year daily total return, and a 12.8% 3-year daily total return. Here's the annual total return history, and you can see that most years are going to be green. We did have a red year in 2018, 2015, and 2008. So because large cap companies, which are companies with market caps of over about $10 billion, are usually more stable options with less risk and more surefire cash flows, it doesn't make sense to go with an ETF that monitors these types of stocks in bulk. These large value stocks are also known to outperform growth stocks in the long run, potentially making VTV a very solid long-term investment for those who want to broaden their focus to many large cap stocks and are looking for an option that is less volatile and unpredictable. And if you look at the portfolio that VTV holds for us, it makes sense why we should feel comfortable with the overall performance of this ETF. The 10 largest holdings of this fund include Warren Buffett's Berkshire Hathaway, United Health, Johnson & Johnson, Procter & Gamble, Exxon, JP Morgan, Chevron, Pfizer, AbbVie, and Coca-Cola. We notice that there are several companies on here that are well known for their durable competitive advantages, and we can also see that VTV likes to focus on valuable healthcare companies that are playing major roles in modern health. And based on the recent performance of the fund over the past few years, following one of the craziest bull runs the market has ever seen, I don't think it's unreasonable to predict that we're slowly leaving a growth-oriented market and that the market has largely recuperated from its 2020 losses. And if this prediction holds true, there's no strong reason against investing in this fund if you do want to solidify your funds in durable value stocks. Next up, we have Kraft Heinz, stock ticker KHC. Kraft Heinz is an American multinational food producer that was formed by the merger of Kraft Foods and Heinz. Other subsidiary brands under the Kraft Heinz umbrella include Boca Burger, Grey Poupon, Oscar Mayer, and Philadelphia Cream Cheese. So right now, one share of the stock is trading at $37.83 with a 52-week low of $32.78 and a 52-week high of $44.87. Here's the one-year price chart. You can see that 1 year ago, they're trading at over $43 a share, really dropped down in price throughout the last year. But since the very beginning of 2022, we have seen some pretty massive gains, followed by a recent pretty big correction. We have a market cap of $49.812 billion, P ratio of 38.21, earnings per share of 99 cents, and they do pay a great dividend of 4.01%. We have a 5-year expected PEG ratio of 2.83 and a price to book ratio of 0.96. We have a profit margin of 4.77% and a very low return on equity of 2.47%. In the last 12 months, they've hit revenues of $25.69 billion, and right now they have total cash of $2.98 billion with a current ratio of 1.02. Unfortunately, its dividend payout ratio is 161.62%, which is definitely something to be concerned about. It's always interesting to see what analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating it as a 3, meaning it is a hold, and the average analyst price target is $42.88, which is about 15% higher than the current price of $37.83. So whereas other companies struggled heavily throughout the 2020 pandemic, Kraft Heinz received a financial boost over the past few years. The business logic here was that because people were indoors more often, more people ate at home. This led to a greater demand for ready-to-eat foods, and guess who manufactures and sells quick prep meals? You'd be right if you said Kraft Heinz. And this stability and durability in a time of economic struggle reflects the fortification of the company's business. But how's this still relevant, right? We're in a way better state now than we were 2 years ago. Well, KHC has proven to be a grower as of late until it was hit by a big correction about 2 weeks ago. The catalyst, banks becoming bearish on the stock due to worries of inflation and its impact on the company. And while there is substance to these worries, they are still just worries about something that is still wildly unpredictable. And if there's anything we've learned, it's that Kraft Heinz can survive the most unpredictable of circumstances. Some more bearish news is that 3G Capital will distribute some of its stake in Kraft Heinz to investors in its fund. This would allow the Brazilian US investment firm to embark on new acquisitions and investments. So basically 3G investors would receive 80 million shares in the group, which is equivalent to about 7% of Kraft Heinz. And this would give them the chance to potentially sell KHC shares. If they do this, of course, it's not going to be good for the share price. But yeah, this decision was made as 3G observed how Kraft Heinz shares have outperformed the broader stock market, especially in the past year to date. Given the company's proven durability and its recent overall growth, as well as the fact that Kraft Heinz may be trading at a slight discount right now, I'd say that KHC is definitely worth checking out. If you want an even better resource for finding top stocks to buy, I encourage you guys to check out the sponsor of this video, Moomoo. This is one of the best platforms I use to both research and buy stocks. And right now, using my exclusive link, you can get up to 6 free stocks with a free share of Lucid when you make your first $100 deposit. Essentially, Moomoo brings professional grade tools and data to you as the investor, all for free. For example, they give you level 2 data at no cost, while other popular trading apps charge between $2 to $5 per month. Moomoo's stock picking tools like heat map, institution tracking, stock compare, and analyst ratings all help me choose which stocks to buy. And they even have analysis tools that look at valuations, candlestick patterns, and more. For example, I have Kraft Heinz pulled up, and you can see that they have a really solid interface. And if I come here to analysis, you guys can look at the daily short volume, the interpretation of indicators. So it is saying it is a bullish positive signal, company valuation, institutional holdings, and of course, analyst ratings. You can see that based on 20 institutions, the target price right now is on average $42.87, which is much higher than the current price of $37.83. I really do think the features speak for themselves, and it's why I'm so happy that they're one of my long-term partners. Again, if you want to get free stocks, Moomoo is hooking it up for my audience, and you can use my exclusive link in the description or pinned comment and get your 6 free stocks with 1 share of Lucid. And now back to the video. Okay, next up on our list is Citigroup, stock ticker C. Citigroup is an American multinational investment banking and financial services company. They're headquartered in New York City, and they're one of the largest banks in the US as well as in the world. So right now, 1 share of Citigroup is trading at $53.62 with a 52-week low of $45.40 and a 52-week high of $80.29. Here's the price chart for the last year. You can see that the price of Citigroup has been going down with a slight increase in price recently. And they have a market cap of $104.126 billion, a P ratio of 6.3, which is super low, earnings per share of $8.51, and they pay a great dividend of 3.77%. They have a price to book ratio of 0.54, meaning it could be undervalued. And yeah, looking at the profitability, we have a profit margin of 25.17% and a return equity of 9.15%. This is all in revenues of $72.76 billion in the last 12 months. Their balance sheet shows total cash of $956.89 billion, and their dividend payout ratio is just 23.89%, meaning we still have a lot of cash that can be reserved for growing the company. Analysts are rating it as a 2.4, meaning it is between a buy and a hold, and the average analyst price target is $66.45, which is over 20% higher than the current price of $53.62. So as you guys saw, Citigroup has unfortunately had a pretty bad past year. In the last 6 months, the bank stock fall by 17.5%, trading at a significant discount to its book value. One reason for this drop in value is that the bank failed to match the returns of its competitors, and as a result, they've been trading for a massive discount compared to its peers. On top of this, the bank has faced regulatory issues and poor international performance. So what are some redeeming things to take away from the company right now? The reason for the bank's poor international performance is due to the sale of international institutions, but this performance can still definitely turn around. More specifically, the sale of these institutions will free up some capital and allow Citi to focus more closely on a smaller set of objectives. And you guys, even more bullish news, Warren Buffett and Berkshire Hathaway have invested in Citigroup. This could be a bullish sign for investors because Citi has been trading at a discount for a long time, but only recently has Buffett decided to invest. That makes me think, does Warren Buffett know something that we don't? I feel like this is a pretty good reason to at least keep this on your watch list because, as we know, Warren Buffett is extremely knowledgeable and he's very good with the banking sector. Overall, the fact that Citigroup is trading below its tangible book value should be pretty interesting for most, because I definitely do like buying stocks when they are at a massive discount. The question is though, how long will it take Citigroup to get back to its market value? I think in the long run, it should go back. So that's why I think this is a stock to consider in June 2022. Next up is NRG Energy, stock ticker NRG. They're an American energy company based in Texas that specializes in energy generation and the sale of electricity. Right now, one share of NRG is trading at $46.46 with a 52-week low of $31.94 and a 52-week high of $47.82. Here's the one-year price chart. We can see that we started 1 year ago at just about $32 a share. It grew heavily to over $45, went back down to about $35, went back to about $43, and then back down to $35, and then it just shot up very recently. So definitely pretty volatile stock. Its market cap is $11.024 billion. They have a PE ratio of 2.83, earnings per share of $16.39, and a great dividend yield of 2.99%. They have a price to sales ratio of 0.42 and a price to book ratio of 2.16. Energy has a profit margin of 14.95% and a really high return on equity of 122.35%. In the last year, they made revenues of $26.79 billion, and their balance sheet shows total cash of $387 million with a current ratio of 1.38. Their dividend payout ratio is just 8.06%, which is great, and analysts right now are rating it as a 2.5, meaning it is between a buy and a hold, and the current analyst price target is $45.18, which is just a little bit under the current price of $46.46. Okay, so Energy is not just any old energy company. Its business offers many modes of selling electricity, including call centers, websites, and brokers. And its portfolio of services is highly diverse, offering natural gas, coal, oil, nuclear generation, and wind generation. The energy company reported earnings at the beginning of the month, where it announced racking in a net income of $1.7 billion compared to negative $82 million the year prior. This growth is insane. It shows that energy has become highly profitable within the span of a year. The company also reported an operating cash flow of $1.6 billion compared to negative $916 million the year prior, which is a very, very bullish sign. You want a company to have a solid pool of cash, so the fact that Energy is able to generate such a ridiculous amount within 1 year after being in the negatives is honestly pretty insane. And finally, the company posted a total liquidity of $2.9 billion compared to $2.7 billion the year prior. This stat means that the company has a greater ability to pay off debts, which is another great sign that really hammers home the prospect that Energy's value can truly grow beyond its liabilities. They also announced a quarterly dividend of 35 cents per share or $1.40 per share on an annual basis. And the company's business is appealing to smaller businesses out there too. One notable recent example is Palm Energy LLC, who announced its acquisition of behind the meter solutions from Energy about 1 week ago. This acquisition includes about 15 megawatts of commercial and industrial customers located in Pennsylvania, New Jersey, Maryland, and New England, which will increase Palm Energy's managed energy megawatts in those markets. Overall, I do think that it's a very interesting stock to have on your watch list. So the next stock we're talking about is Marathon Oil, stock ticker MRO. Marathon Oil is an American oil company based in Ohio and one of the largest oil companies in the world. So right now, one share of Marathon Oil is trading at $31.16 with a 52-week low of $10.41 and a 52-week high of $31.16. So yeah, we are at the 1 year high. Here's the 1 year price chart. You guys can see that this stock has performed extremely well. It was pretty flat for the last half of 2021, but since the beginning of 2022, the share price has just shot up through the roof. They have a market cap of $22.052 billion, a P ratio of 11.19, earnings per share of $2.78, and they pay a dividend of 1.1%. Yahoo Finance is marking them as near fair value with really positive performance outlooks. Looking at the profitability, we have a profit margin of 34.7% and a return on equity of 19.54%, which is very good. They've seen revenue in the last 12 months of $6.21 billion, and their balance sheet shows total cash of $682 million with a current ratio of 1.1. For their dividend, their payout ratio is just 7.69%, meaning that a majority of the money is going back into the growth of the company. Analysts are rating Marathon as a 2.2, meaning it is a buy, and the average analyst price target is $32.76, which is just a smidge higher than the current price of $31.16. So Marathon Oil is an oil company, and due to current world events, oil prices are much higher than usual. And I know you guys have personally seen this when you go to fill your cars up with gas. The thing is, Marathon Oil did not hedge its position in commodities, so growth in oil prices will actually enable the company's value to skyrocket. To clarify for some viewers, hedging means taking the opposite position for an asset you're already invested in to offset potential losses. In other words, hedging reduces risk, which also reduces the reward. This particular company did not reduce its risk, and so it didn't reduce its reward as well. So hence the stock price has just gone through the roof. And this crazy growth really reflects this highly favorable business decision. More importantly, in the last earnings report, Marathon reported an earnings per share of $1.02, which beat the consensus estimate of 98 cents. Now, the oil company is expected to post earnings of $4.94 per share on $8 billion in revenues, which equates to well over a 200% change in earnings per share on 46% change in revenues. And let's not forget to mention the fact that the company reported 5 consecutive quarterly base dividend raises and the repurchase of $1.6 billion worth of shares within the last 7 months, reducing its outstanding share count by 11%. Now, like I showed you guys, Marathon Oil is at a 52-week high, which is up about 80% in value since the start of the year. As oil prices continue to sit on top of a steep hill, Marathon Oil still has plenty of room to grow, I think, and with the cash flow that is already receiving, we investors can believe that the company will continue to reinvest in itself. Overall, MRO is an interesting play if you do want to get in on oil right now. And yes, it's a little risky because it is at an all-time high, so make sure to do your own due diligence before investing. All right, last up on our list is Vertex Pharmaceuticals Incorporated, stock ticker VRTX. This is an American biopharma company and one of the largest biotech companies in the US based in Boston, Massachusetts. This is the highest priced stock on the list at $273.73 with a 52-week low of $176.36 and a 52-week high of $292.75. Last year, we've seen tremendous growth. It was pretty flat in the last half of 2021, but since January, it's just absolutely gone up in price a lot. They have a market cap of $70.317 billion, a P ratio of 28.89, and earnings per share of $9.48. They have a 5-year expected PEG ratio of 0.38 and a price to book ratio of 6.06. They have a great profit margin of 30.84% and a return equity of 24.65%. This is on revenues in the last 12 months of $7.95 billion. They have total cash of $8.24 billion and a very high current ratio of 4.75. Analysts are rating them as a 2.1, meaning it is a buy, and the average analyst price target is $291.93, which is under 10% higher than the current price of $273.73. All right, so Vertex Pharmaceuticals is known for being one of the first biopharma companies to employ rational drug design over combinatorial chemistry. Combinatorial chemistry involves making a bunch of different test compounds and narrowing down which one accomplishes a goal the best, whereas rational drug design is more about addressing a molecular target and building a compound around that target. The latter strategy reduces time and cost, but it does come with a greater risk of failure and stagnancy. By incorporating this strategy into its business, Vertex is responsible for the production of dozens of groundbreaking drugs. The most notable examples are ivacaftor, lumacaftor, and tezacaftor, 3 therapeutics whose development have evolved to become a triple combo therapy for cystic fibrosis, working with CRISPR therapeutics to treat blood disorders like sickle cell disease and beta thalassemia, as well as working with Moderna to develop mRNA-based treatments for cystic fibrosis. Vertex is also responsible for the development of crucial painkillers and anti-diabetics, with new ongoing developments in their pipeline today. What's more impressive is how Vertex has been using its resources and extra funds to reinvest in its own business. They recently announced its further expansion in Boston by building another 300,000 square foot facility that will make Vertex the largest biotech company in Boston in terms of square footage. And another recent announcement was that Vertex committed $50 million of health equity. These grants include clinical trial diversity, access to quality care, and education of the healthcare workforce. By investing funds into its own expansion and the consolidation of outstanding healthcare practices, Vertex is really reinforcing its name and reputation in the healthcare industry. I don't know about you guys, but I feel like Vertex has so much going for it, and given its longevity and durability in its sector, I do think that they are a very solid healthcare pick. Anyways, those are my top 6 stocks for the month of June 2022. And if you do want to get some free stocks with Moomoo, I will put the link down below. And yeah, with all investing, make sure to do your own due diligence and don't just buy any stock because it was listed in this video. This is just an analysis of 6 different companies that I currently like, and I'm not a financial advisor. I'm just a person making videos on YouTube. So yeah, make sure to do at least 1 hour of due diligence per stock that you're considering. Anyways, I hope you guys enjoyed the video, and if you did, make sure to share with a friend, as well as like and subscribe for more content just like this. I make a ton of content about investing, personal finance, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.